Welcome to a Millennial's Guide to Real Estate Investing. Here is your host, Antoine Martel.
Hello everybody and welcome to another episode of a Millennial's Guide to Real Estate Investing. Today I'm sitting down with Eddie Lorin. He's a real estate investor who's been investing in multifamily affordable housing for the last 10 years. He now owns and runs Impact Housing, which is a REIT, Real Estate Investment Trust. So thanks for coming on the show, Eddie.
Pleasure to be here.
Yeah. So first, I just want to get started with, your background story. You've been investing in real estate since 2008. So why real estate?
Well, I've actually been investing since 1987, but I've been in this last iteration after I left a big company. We started our company in 2008. But I started at Long Beach, California, of very modest means. I lost my father when I was 10 months and my mother when I was 17, so I was kind of basically orphaned. And we always had a good life, but, we didn't have a lot of money. So to me, it was always a goal to make sure that everybody had a clean, decent, safe place to live. And so that's what we really focus on, and we've over the years developed a really cool knack at taking what we call blight and making light. And so our concept is we go into older units and we make a clean, safe, affordable place to live. We treat people with respect and dignity. They stay, they pay, and they refer their friends. It's a very boring business, but it's very, very rewarding.
Yeah.
And, the whole concept of impact investing has always been something that's important to me. You can do well by doing good, make a profit with a purpose. And your audience, I know, as the millennials, they really do believe, like I do, that can make a difference and money at the same time. So it's very exciting what we're up to. It's the first crowdfunded REIT that's focused on impact. And it's just doing the same thing we've been doing for many years. We create affordable housing out of older product stock, which we call a naturally occurring affordable housing. Seems pretty logical and common sense, but most people are building beautiful new shrines to affordable housing, and it just doesn't make that much economic sense. It needs a lot of subsidies from the government, but we just buy workforce and low-income housing and do that same value add, we call it, and give people that value, because it's about value for the investor, value for the resident, and value for our managers. So.
Yeah. And then, so what did you start doing back in Long Beach in 1987?
Well, I went to UCLA and I put myself through school, and I worked did various real estate companies, ended up working for a lot of older. I'm a Jewish guy, so I worked for the Jewish mafia and learned a lot. That's what I call it. So, and then I moved on and worked for another character starting in about the late 90s, and we bought about 25,000 apartment units in 10 years. Wow. So I really experienced in the nationwide with various brokers and management companies. So I became what you call a player, I guess, on his nickel.
Yeah.
And went on my own after I've seen what to do right and what you can do wrong. So
Gotcha.
You learn more from the mistakes you make along the way than you do. So I was blessed to have a lot of experience before I started out on my own.
Yeah. Yeah, and that's super important too, because when I first got I didn't do my first deal until 2 years of kind of in the learning process, and that was through a bunch of different mentors like that too. And that's what I tell people all the time is go find somebody who's doing what you want to do and just do whatever you can to learn from that person and spend time with that person. So then after you had those series of mentors, what did you go and do on your own after that?
Well, we hooked up with a couple of what called family offices, and they wanted to do some deals, and it was the right time. So in 2009, when we started, it was a pretty bad economy. Yeah. We were lucky enough to find some good investors who wanted to go and do stuff. So we perfected our concept. We start from the street, and we look at a sign, and we want someone to look at our new sign and say, I only wish I could afford to live there.
Yeah.
And behold, they can live there. So really nicely appointed paint jobs, state-of-the-art fitness centers, resort-style Vegas pools, outdoor fitness, dog parks. You get inside, and the renovation of the units is very tasteful but not over-improved. So we can give people that value without having to charge too much for rent, and we can stay full because again, it's all about value.
Yeah. And
vision.
And then in 2008, were you living in LA and investing in LA, or were you investing out of state?
Nationwide.
Okay.
Yeah.
Okay.
Definitely.
And then where did you start buying back in 2008, 9?
Vegas.
Vegas.
It was the worst market in the world.
Yeah.
It was great. I Vegas. I always did love Vegas.
Yeah. And are you still investing in Vegas?
Yes. We just bought a high rise. And we're transforming that. It's right behind the convention center.
Yeah.
So
and
that was pretty cool.
Are most of the deals that you're buying now, are they apartment buildings that are currently like Section 8 affordable housing, and then you're...
No, just workforce housing. We're taking older product and deeming it affordable.
Okay. And then are you doing that through Section 8 or...
Well, we'll take Section 8 vouchers, but we don't put it... You can take a voucher which is a movable voucher with the tenant based. That's what we go with. But we don't do get a contract on the entire building. That's what's called project-based Section 8. We do not do that, no.
Okay. And then do you get some sort of government subsidy or city funding then for being affordable housing, or how does that work?
That's a good question. It took me 2 years to get the first deal done in Los Angeles called NOAA, Naturally Occurring Affordable Housing. We are getting a property tax abatement in exchange for deeming units affordable, and we're setting them aside for the homeless and for transitional and supportive housing. So yes, that's where we're working toward.
Okay.
But it's very hard to get these local jurisdictions to step up and do stuff. So it's well,
because I know the government does do some government subsidized, like if you want to go and build an affordable housing building, the government will give you funding for that too.
Tax credits, yeah.
Yeah, the tax credits. But I mean, it takes like a year or two of paperwork to even get to that process and get your... Right. Have you ever gone through that?
Well, yeah. And the challenge is getting everything lined up, like you said. So it's better to just buy existing
Yeah, way easier. Yeah, me too. All right. And then how have you, when you're looking at a market, then are you looking for some certain criteria that would deem it affordable?
Well,
that would fit your model?
It tends to be older product that's neglected.
Yeah.
And so what do? You lower the rents. So we can fix these properties up, keep the rents affordable, and that's the formula.
Okay. Gotcha. And then how have you been finding your deals over the last couple of years as multifamilies got tight?
I've got great broker relationships, and my famous line is good deals are made, not found.
Yeah.
So it's very important distinction that when you're skilled at something and you have vision and you can see what other people don't, you can buy a property and transform it where other people can't make it pencil.
Yeah.
And we've done it over and over again. So it's really about making deals work.
Gotcha. And then are those broker relationships from the past, or are you continuously?
Yeah. Well, you're continuously meeting people, but look, people know me. I've been around a long time, and if I say I'm going to do a deal, I do a deal. But a lot of things we pass on. They don't work. They don't pencil, and whatever. But it's no harm, no foul. There's plenty of buyers out there for all these brokers, as long as you treat them well, and it's good.
But what would you recommend for somebody who's looking to get into multifamily to go and, especially out of state? Because I live in LA. I have been investing in single families, duplexes, quads, all out of state. And those can be easily found on MLS. So it's been no trouble. But now I'm starting to get into the multifamily side of things. And now broker relationships are key, but they're also harder.
You start with LoopNet.
Yeah.
And you get the names off of LoopNet and you start schmoozing them.
Yeah.
That's
okay, good. I've been doing it right.
People they like.
Yeah.
That's it. And you just establish your credibility and you kid around with them. You make sure you meet them. You walk the property. You do all those things so they know your intent to get a deal done. Because the worst thing for a broker in the world is to go and escrow with someone who ruins their credibility because the seller's relying on them. And either they don't close or they can't get it financed or whatever, then the broker looks bad and they'll never talk to you again.
Yep.
So you got to make sure that you are lined up and you are ready to close.
Gotcha. Okay. And then since you are, how have you been funding all of these past deals that you've been doing? Do you get because you are affordable housing, do you get some sort of some?
No.
No, you wouldn't, huh? Because it would take too much
No,
paperwork.
it's friends and family. It's like I have some Israeli investors I'm doing
Yep.
my second deal with, but mostly friends and family because that's the best deal for
Yeah.
you as an investor, syndicator, because you go to the geniuses from Wall Street and they'll cut your what's off.
Yep. Yep. Exactly.
I've done that many
Yeah.
times. That's how I got so big but it's not worth it sometimes.
Yeah.
Sometimes it's better to do fewer good deals and have good quality partners rather than ball busters.
Yep. Okay. And then did you start off syndicating your deals with friends and family?
No, I started off doing high leverage for that other guy,
Oh, really?
and we did 95% leverage deals on 25,000 units. So it was a big
man.
big operation. I was the head of acquisition, so I really 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 learned and cut my teeth.
Yeah. Wow. And then when did you get into the whole REIT side of things?
Well, I just started this. It's a crowd-funded REIT for millennials. I think it's the best fit, and so I just formed it with the SEC and doing crowdfunding. Now, non-accredited investors can come in, so anyone and
Oh,
everyone,
wow. That's what I was going to ask.
level or wealth, can come in. So our minimum investment's $1,000
Wow.
to buy this real estate. Never used to be possible before the Jobs Act in the last administration.
Okay. Yeah. Yeah, I was wondering about that Jobs Act because I remember we were looking at opening a REIT or even just a small syndication, and we went more towards the syndication side of things just because we didn't have to. Then you don't have to go through the SEC if you keep it small.
Yeah, 5-6C, and
Yeah. Yeah. Exactly.
but they're
Okay.
only accredited investors.
Yep. Yep. Okay. So your REIT then opens it up to non-accredited, and anybody can invest as long as they have $1,000 to invest. Okay. Awesome. And then is there a cap on the? No, there must not be a cap because sometimes for the syndications, there's like a cap on the amount of people that can be invested in.
Well, because we went through the SEC, it's unlimited.
It's unlimited.
But yes, normally there is a cap.
Yeah. Okay.
It can be anywhere from 35 to 100. But if you're doing big checks, it doesn't ever become a problem.
Yeah. Okay. And then why is your REIT for millennials in your opinion?
Because I think that I know the older generation is not that comfortable investing online still.
Yeah.
So, the younger generation, there's about $14 trillion that's going to transfer from the baby boomers to the millennials. And that's going to be a huge source of capital for new investments.
Yep.
So that's what I think is going to be interesting. And that generation, your generation, is more used to investing online than my generation.
Yeah. Okay. And then what are your targeted returns? Is on a deal by deal basis or?
We always target a 5-year IRR of 20. So that means a 2x on your money. That's what our target is.
Okay.
And the way our investment program works is the first $1 out, and I got to be careful because the SEC, how I say this,
Okay.
is 7% pref to the investors first, and then we do a split on a waterfall, and it's all online at impacthousing.com if anybody wants to check it out.
Okay. Awesome. So 7% preferred, everything else is just a waterfall after
Yep.
that. Can you explain what a waterfall is?
Sure. After everybody gets a 7% return and their money back, then the good guys, which I call the syndicators, us, the good guys get to finally make some money. So we split in accordance with a waterfall, meaning any dollars that are returned after that 7% are split 35% to the promoter or the syndicator like us, the operator, and then 65% to the investors.
Okay.
And then after we hit a 16% return to everybody, which is a phenomenal annualized return, then we go 50-50.
Cool.
And so that's what a waterfall is.
Okay, so you only have a 2-step waterfall. Yeah. Okay. Good. Kept it easy, huh? I've seen it before. It's like some people go crazy with the waterfall. Okay. And then how are your investors who invest in the REIT, are they paid back monthly on their money? Is it just an annual check?
Quarterly dividends.
Okay. Awesome. And then can people invest through the website?
Yes, absolutely.
Okay. Got it. And then is there funds is it on like a per deal basis or is it?
Well, it's going to be, we're doing our first deal now,
Okay.
and it's a high rise in Maryland where we're actually doing a public-private partnership with the county to put on affordability for the units, and they're giving us some financing
Oh, really?
in exchange for that, so that the equity is, so we need less equity, and then the returns will be good enough. So we'll have one deal, the first deal will close, and then subsequent deals will come in after, and then the fund will be closed, and then we'll sell after the 5 to 7 year period, and that's that.
Okay. And then are you getting any other financing from a bank?
We're getting Freddie Mac. Yes.
Freddie Mac. Okay. Awesome. So tell me more about that deal then. So this is the deal that you're currently raising for, correct?
Right.
Yeah. And then how did that deal come about, and tell me more about it?
There's one of our very dear friends who's a broker in the DC area came across this property and said, this is definitely what you want, what you're looking for. It's 12-story high-rise with beautiful balconies, and it's been totally mismanaged and unloved.
Yeah.
We like to find deals that are unloved or unknown, right? So
Yep.
this is unloved. The hallways are really ugly, and so we're going to completely transform this property. We got a 3,000 square foot downstairs area we're going to make into a state-of-the-art fitness center. We're going to make it a club room and do a lot of programming there, and some public storage for the residents, and do the rehab of the units, and really transform them into great units that are going to be at certain levels of area median income. And that's how the affordable business is tagged. So let's say the area median income is 50,000. 40,000 is 80% of area median income in simple math.
Mm-hmm.
So nobody can make, for a one-person household, more than 40,000 in this example. And then nobody can pay rent higher than 30%, because that's the goal. So nobody should pay more than $1,000 a month.
Okay.
And that's how you do it. That's what affordable housing. So unlike, there's this big, you're a California guy too, they're talking about Prop 10. Prop 10 will be the worst thing in the world for affordable housing. Everybody thinks it's a great idea, but it's a stupid idea, because it will disincentivize people from building new product, because they won't be able to get the higher rents. Let's leave the higher rents to the new stuff, and let's make all the existing stuff affordable, which it should be.
And what is Prop 10 going to do?
It is going to allow all of state of California, every city, to opt in to rent control.
Oh.
It's a real problem, and everybody
Yeah.
thinks it's going to help solve the problem.
Yeah.
But it's really bad.
Yeah. Okay.
So if you're in California, vote no.
Yeah.
And I'm an affordable housing guy. I'm a champion for the underdog, and I'm telling you, this is not going to do what we needed to do. We need to build our way out of this. We need to build a lot of product, because if there's a lot of supply, then the rents get calmed down.
Yeah.
Not by putting in these rent controls, and you'll be like New York, where generations keep the same apartment.
Yeah.
And they never let it go.
Yeah.
So, you're paying $500 a month for rent, and they're subleasing for $2,000, and the landlord can't do, what, to get them out.
Yeah. And then you think that's going to, then limit the amount of development because of the rent control, and then nobody's going to build, and then all the units that are there are just going to go through the roof.
Yeah.
Supply and demand, right?
Called irony. Yeah.
Okay. So more about this. How many units is this deal?
143.
143. So the max rents that you can charge is $1,000.
Well, in this example.
No, yeah, of course. But I'm just wondering how it works, because, for example, if you're buying a property that, do you typically, like, for example, are the rents currently $600 and you're going to raise them up to the maximum that you can to be affordable? Do you normally see that, or is it reverse?
No. Things are too expensive.
Yeah.
And the issue is you're going to try to keep them at that level and try to make it work.
Okay.
And that's what you need that was the LA example. That's not what is happening in Maryland. But the concept is we need a property tax abatement, and we need something to offset capping these rents. So
Okay.
it's quite the opposite.
So for every deal, then the deal won't work unless you get some sort of tax abatement, tax credit, something,
or some financing from the government, which is what we're doing here in Maryland.
Okay. But how long does that whole process take then for that deal? I mean, you must have put it in contract like 4 years ago.
No, it was just the fall. But we're almost on a year. But the county had the right to purchase the property. They exercised that right. I stood to lose a lot of money, and I went into them and said, "Hey, I'm going to make it affordable anyway. Why don't we work together?" And finally convinced them. But believe me, took years off my life.
Wow. Okay. And as all the past deals that you've done in this similar manner, just you always have to find some sort of, and is every way you look for a different, I mean, that must take a lot of time of.
I know, that's the problem. Here you're trying to do the right thing, and it's so difficult.
And they make it a pain. Yeah.
Yeah, that's bureaucracy.
Yeah. Because even for my neighborhoods, I mean, I invest in the Midwest, Memphis, Cleveland, Akron, Birmingham. And I've, been buying single family homes or up to fourplexes, and it's pretty low income housing too. I mean, we charge $700, sometimes $600 per month for a single family home, or even just a unit in a duplex. So we're in the same range as you as well. C-class blue collar neighborhoods, but there was also a ton of land available in these neighborhoods where we wanted to go and build. And I was like, okay, I can build some houses or build an apartment building and just rent it out for the same dollar amount, but I'm going to need some form of funding to get it done, or else the numbers are not going to work. So I went and researched it, and for example, in Memphis, I went and researched it and to look and see if they were giving any type of tax incentives or even just the financing to do those kinds of deals. And I went through the whole package that they want you to fill out and the timeline, and it was just like, okay, there's no way that this land is just going to sit here, because nobody's going to come and do this for a 4-unit apartment building, which is going to cost $200,000. It was just ridiculous, the amount of paperwork, and the timeline was literally a year and maybe 9 months before you even heard if you were approved or not for that project. So it goes back to your point that it's when you're trying to do the right thing, it's like they make it so difficult, and there's no easy way to get that financing when the government should be throwing it out, especially with the way the market is right now.
And I've been trying, maybe before I die, to get foundations to do that, because they have low cost money, and they should be doing that.
Yeah.
I just wrote an article in Forbes about that.
Really?
Hopefully someone will listen.
And so what was that? Having the foundations, because there must be foundations that are low income housing or affordable housing who should be developing properties as well.
The simplest thing is, when you're trying to make that $600 rent work at $800, what if for the first 5 years this foundation came up with that $200 supplemental voucher, and then that $200, as the market rents go up, it becomes $700, and they only need to put in $100.
Yeah.
And now you can afford to do that, but you need help and assistance, and so that's the challenge.
Yeah. And then have you thought of, or have you partnered with any, and then come into them, be like, I'll be your developer, just help me with this aspect? Yeah. Ever work or no?
Yeah. It's in the process. It's a long process.
I know.
The people that should take, they're as good. They should take the most risk, and they take the least.
Yeah.
That's the funny thing.
Yeah. Wow. All right. And then back to the deal in DC.
Right.
For the rehab, so you're gonna go in, renovate the units, and then
we'll spend about $4,500 on the interiors.
Okay. Per door?
Yeah.
Okay. And then is the property currently fully occupied, or how's the situation now?
It's fluctuating because it's been in escrow so long, as you alluded to,
Yeah.
and seller drops the ball because no seller cares if it's already, going to close. So that's the problem. So we got, it's around 90%. It was very fully occupied, but we got to go fill it up again.
Yeah.
But they neglect it.
Yeah.
The key to this thing is there's they built 48 townhomes attached to the same water main as the high rise, and they're individually owned. And so the high rise that we're buying, they were guessing and billing back a very low amount. So we expect to get a lot more out of that association. They're not going to know what hit them when we take over.
Yeah. Okay.
Because they're not paying their fair share.
Yeah.
So it's a $50,000 meter they were too cheap to put in, and that's going to dictate exactly what they're using, and they can't argue.
Wow. Really? Huh.
Yeah.
And then are all those townhomes that they built then, are they like high-end townhomes that are all connected to the... Wow. Okay. And then when you find these deals and you come in and, with your strategy and what you're going to do with it, do you tell the sellers, hey, I'm going to be under contract for, like, how do you convince them that you're going to need to be under contract for 12 months?
They don't think that. The only reason we're under contract that long is because the county exercised their right to purchase.
Oh, really?
They screwed it up.
Okay. So typically...
A typical deal is 30 to 45 days of due diligence, 30 to 45 days to close, and then another 30 days we put up another extension of 50 or 100 grand to get the lender to close. That's the typical deal. It's usually 4 months.
Got it. And then within that time frame, that gives you enough time to go to the city or county and get those tax credits or abatements?
That takes
tight.
a lot. That's a lot longer.
Okay.
But that's what we did in LA, but we're still not done. We closed with a bridge loan, and now we're going to refinance out with the county.
Oh, wow. Oh, so you closed without that even lined up? You had to.
Because the seller's not going to wait that long.
Yeah. Yeah, exactly. That's what I was saying.
Yeah.
Yeah, because
we're complicated. Look, everything's complicated. Every time you think you got it, you've seen it all.
Yeah.
Something else comes along.
Got it. All right. And then do you have any other, why Baltimore? What made, or
I just love the Beltway, and I think Amazon's coming.
You do?
Yep.
They have a couple of different cities, right, that they're looking at? The Carolinas.
20, but he owns the Washington Post. He's liberal. He's not going to Dallas. That's not in the middle. I mean, that's red.
Yeah.
And besides it being red, it's not really his kind of place.
Yeah.
Because he needs to be on the East Coast. He also bought a house there, and he's got a lot of political issues with sales tax. So by locating in D.C., he can pull some favors. So that's what my opinion is.
Got it.
It's just one man's opinion.
And then in terms of the property, what are things that you look for in terms of location? Like for me, I always look for stuff that's on a main road and close to jobs, and because it helps with marketing and filling units. Is there
public transportation?
Public transportation.
Transit-oriented communities, TOCs. That's what we look for.
Okay.
You want transit.
Got it. And do you care if you're on a main road or on a...
Sure. Yeah, you want that visibility and the traffic, the drive-by traffic and the walk-through traffic.
Exactly.
Yeah.
Have you done deals in D.C. before?
Yeah.
Yeah.
3. Yeah.
Oh, wow. Awesome.
D.C. area. D.C. itself is hard because there's a lot of politics in the district, but we're actually closing with these Israelis on, it's a separate joint venture in the REIT, but we're closing on, and it's literally a golf shot from D.C., but it's not in D.C.
Okay.
In fact, we're trying to go hard today, and I may have to jump soon because the lawyers are calling.
Okay. No problem. Yeah, we can wrap it up shortly. Well, anything else that you would recommend for a millennial who maybe just graduated college, has their first job, wants to get involved in real estate, but doesn't have the cash to do so?
Learn.
Yeah.
Just don't rush into it. The more you mentor with someone, the more things you've seen. You need to see a cycle go bad. That's another thing. It's not a good thing to go out on your own until you've experienced a cycle or two. So don't even think about going on your own until you're 40, is my opinion. But learn as much as you can. Try to buy stuff on the side. Do whatever you can. But stay working for a good organization where you can learn and have camaraderie, and you see a lot of things go wrong, and that's how you learn what to do right.
Love it. And then how would you recommend somebody finding a mentor?
You just
or that person?
Read the trades, and ask someone for lunch or for coffee. Can you take them out and pick their brain? And, you remember when you started in the world looking for someone to help you. As long as you ask for help and you're not asking for money from people, they're always happy to help. You always got to appeal to their paternal or maternal instincts.
Yep. Yeah, I love it. Yeah, I always say just go on Bigger Pockets and just network just send messages to everybody who's done a couple deals in the location you want to do, or has done a couple deals in the certain realm you want to be in, and just ask them to take them out to coffee and, offer them, give them some sort of value too, and don't ask for anything, but
other than advice.
Yep, exactly. Well, awesome. Well, thanks for spending the time with me today. It was great to pick your brain a little bit and sit down with you. And how can people connect with you if they want to, or learn a little bit more about your company?
Well, you can Google my name, Eddie Lorin, Lorin, or impacthousing.com.
Awesome. Thanks for spending the time today, and hope to chat with you soon.
Pleasure. All the best.
Have a good one.
You too. Bye.